Welcome back to our daily S&P 500 technical analysis update. In today's video, we'll be covering some key topics that you should consider when analyzing the S&P 500 index from a technical perspective. So, let's dive right in. Before we start, it's important to note that technical analysis involves studying historical price and volume data to make predictions about future price movements. It can be a valuable tool for investors and traders to make informed decisions. Now, let's explore the topics we'll be covering today. Market overview and index performance. To begin our analysis, let's first take a look at the overall market performance and how the S&P 500 index has been behaving recently. We'll examine the current market trend, support and resistance levels, and any significant price movements that have occurred. The market trend of the S&P 500 index has been in an uptrend since October 13, 2022. This means that the overall direction of the index has been upward during this period. Since the uptrend began, the price of the S&P 500 index has been making higher highs, which indicates increasing bullish momentum. Specifically, we observed higher highs in December 2022, February 2023, and June 2023. These higher highs suggest that buyers have been in control, pushing the price to new peaks. Currently, the S&P 500 index is approaching a key resistance level of 4325.28, which was set in August 2022. This resistance level represents a price point where selling pressure has historically been significant, causing the price to reverse or stall. As the index approaches this resistance level, it becomes a crucial area to watch. If the price manages to break above the resistance level, it would suggest a potential continuation of the uptrend, with the possibility of further gains. On the other hand, if the price fails to break above the resistance level, it could indicate a potential reversal or consolidation. Analyzing the market trend is essential as it provides a broader context for understanding the current price action and potential future movements of the S&P 500 index. By recognizing the uptrend, the higher highs, and the key resistance level, traders and investors can adjust their strategies accordingly, considering the potential for continued upward momentum or the possibility of a reversal at the resistance level. By analyzing the broader market, we can gain insights into the sentiment and direction of the index, which will help us in our decision-making process. Technical indicators. Now, let's discuss some commonly used technical indicators that can provide further insights into the S&P 500 index. We'll explore indicators such as moving averages, relative strength index, RSI, and MACD, moving average convergence divergence, among others. In May 2022, a death cross occurred in the S&P 500 index. A death cross is a bearish signal that happens when a shorter-term moving average, typically the 50-day moving average, crosses below a longer-term moving average, such as the 200-day moving average. This event suggests a potential shift in trend from bullish to bearish. Following the death cross, the price of the S&P 500 index declined and reached a low of 3,491. This decline indicated a bearish sentiment prevailing in the market. However, in February 2023, a golden cross took place. A golden cross is a bullish signal that occurs when the shorter-term moving average crosses above the longer-term moving average. In this case, it led to a positive momentum shift in the S&P 500 index. The price rallied and reached a high of 4195.44, indicating a potential upward trend. However, the rally lost steam, and by March 2023, the price declined to 3808. This downward movement suggested a temporary setback or consolidation in the market. Subsequently, in April 2023, a second golden cross occurred. This event further strengthened the bullish sentiment. The price of the S&P 500 index continued to rise and reached a higher high of 4296.58, indicating the potential for further upward momentum. Analyzing moving averages provides valuable insights into the overall trend and potential shifts in the market sentiment. The death cross in May 2022 signaled a bearish trend, followed by a rally after the golden cross in February 2023. The subsequent decline and subsequent second golden cross indicated a resumption of the bullish sentiment. Traders and investors often use moving averages to confirm trends, identify potential entry and exit points, and assess the overall market sentiment. The death cross and golden cross signals can serve as significant indicators in technical analysis and can assist in making informed trading decisions based on the current and historical price movements of the S&P 500 index. The RSI is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is typically used to identify overbought and oversold conditions in an asset. An RSI reading of 66 69 indicates that the S&P 500 index is currently in a relatively neutral state. It is above the midpoint of 50, suggesting that there is still some bullish momentum in the market, but it is not considered overbought. Typically, an RSI reading above 70 is considered overbought, implying that the asset may be due for a price correction or reversal. Conversely, an RSI reading below 30 is considered oversold, indicating that the asset may be due for a potential bounce or upward movement. With an RSI of 66.69, it suggests that the S&P 500 index is in a moderate bullish momentum, but it has not reached an extreme level that would signal an overbought condition. This information can help traders and investors make more informed decisions about potential entry or exit points. It's important to note that the RSI is just one tool among many in technical analysis. It should be used in conjunction with other indicators and analysis techniques to gain a comprehensive understanding of the market dynamics and make well-informed trading decisions. The MACD is a popular momentum indicator that consists of two lines, the MACD line and the signal line. The MACD line represents the difference between two exponential moving averages, typically 12-day and 26-day. The signal line is a moving average, typically 9-day, of the MACD line. If the MACD line is above the signal line, it indicates a bullish signal, suggesting that positive momentum is present in the market. However, when there is a divergence between the MACD line and the price, it could indicate a potential reversal or a weakening of the prevailing trend. The price of the S&P 500 index has made a higher high, indicating upward movement. However, the MACD oscillator has made a lower high, indicating a divergence between the two. This situation is referred to as a bearish divergence. A bearish divergence suggests a potential weakening of the bullish momentum and may serve as an early warning sign of a possible trend reversal. Traders and investors often pay close attention to divergences as they can provide valuable insights into the underlying strength or weakness in the market. While the MACD line being above the signal line is generally considered a bullish signal, the presence of a bearish divergence suggests caution and a potential need for further analysis. It's important to consider other technical indicators, market context, and confirmation signals before making trading decisions solely based on this divergence. As always, it's crucial to use the MACD in conjunction with other analysis tools and techniques to gain a comprehensive understanding of the S&P 500 index's technical landscape and make informed trading decisions. Bollinger Bands consist of three lines: the middle band, the upper band, and the lower band. The middle band is typically a 20-day moving average, while the upper and lower bands are calculated by adding and subtracting a certain number of standard deviations from the middle band. The standard deviation is a measure of volatility. When the width of the Bollinger Bands is wide, it suggests increased volatility in the market. A wide width indicates that the price is deviating significantly from the middle band, which implies strong price movement. If the price breaks above the upper band, it is considered a bullish signal. This breakout suggests that the price has moved beyond the normal range of volatility and indicates potential upward momentum. Traders often interpret this as a signal to go long or hold existing long positions. However, it's important to exercise caution and consider other factors in conjunction with the Bollinger Bands. A breakout above the upper band does not guarantee sustained upward movement. It's essential to look for confirmation signals, such as volume confirmation, trend strength, and other technical indicators, to validate the breakout and assess the overall market context. Additionally, it's crucial to monitor the subsequent price action after the breakout. Sometimes, a price can temporarily move above the upper band and then reverse, resulting in a false breakout. Traders need to be vigilant and assess the market dynamics continuously. The stochastic oscillator is a momentum indicator that compares the closing price of an asset to its price range over a specific period of time. It is used to identify overbought and oversold conditions in the market. The stochastic oscillator ranges from 0 to 100. A reading above 80 is typically considered overbought, suggesting that the asset may be due for a potential price correction or reversal. Conversely, a reading below 20 is considered oversold, indicating that the asset may be due for a potential bounce or upward movement. With a stochastic oscillator reading of 96, it indicates that the S&P 500 index is currently in an overbought condition. This suggests that the index may have experienced a significant price increase in a relatively short period of time, potentially reaching a point where selling pressure may outweigh buying pressure. When the stochastic oscillator is at such high levels, it's important for traders and investors to exercise caution. An overbought reading does not necessarily mean an immediate reversal will occur, but it does suggest that the market may be due for a potential pullback or consolidation. Risk management and stop-loss placement. Having a solid risk management plan is crucial to protect our capital and ensure longevity in the markets. That wraps up our daily S&P 500 technical analysis update. Remember, technical analysis is just one tool in your trading arsenal, and it's essential to combine it with fundamental analysis and market sentiment to make well-informed decisions. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell to stay updated with our future technical analysis videos. As always, we appreciate your feedback and comments down below. Until next time, happy trading.